A lot of banks on a traditional setting, they want to see everything, okay? And again, sometimes it's great to expose that information, but again, if you're in a position that, you're growing, maybe, your profits are not quite there, and you need capital, this could be a great option for you, okay? Like I said, 3 months more in bank statements, and then, like I said, 6 months in business. You get any questions around this?
No, it's just basically 10,000 is the minimum you could,
Yeah.
for the line, $1 million is the max. Bank statements, again, there's gonna be, obviously your revenue is gonna dictate
Right.
as well.
Right, revenue's gonna dictate how much, right, exactly, based on your bank statements. Yeah, the minimum score of 6 is not bad. Again, it's not a bad option for, for a lot of businesses.
Now, is that, does the type of business or industry play a part in that?
Well, it does. This is pretty much for all businesses, but if you're in a, let's say, a marijuana business, I know it's legal now in a lot of places, but, certain businesses are still prohibited. Marijuana, adult entertainment, things like that. But again, if it's, straight up traditional business, business to consumer, you're not doing anything illegal, you're good. You can certainly, this is the win for you. If anything, these two solutions, I recommend, even if you're not in need of capital, right? A lot of times, I don't need them, good, we're doing well as a business. Have a line in place, right? We don't know the future. We don't know what the future lies. The worst thing, and I run into this all the time. I know Eric, he's a business consultant as well, so I know he runs into it a lot as well. The last thing you want to do is you get in a cash crunch, and now you're scrambling trying to look for cash at the last minute. When you have a line in place, boom, it's there. It's there, like it's insurance. It's a safety net for you. Now you want to be responsible with it. You don't want to, abuse it. But again, this is a great solution for someone that can't fit into that cookie cutter box in a traditional setting. We can offer this based on these criteria here. Okay.
So let's say they have the line. Are there any maintenance fees for having the line, or you're just gonna pay as you use?
Well, there's generally there is a initial origination fee for it. Generally, that's about like 1 or 2%, depending on the lender. So it does specify. So it is some origination costs. Of course, the bank does have to make money off of it. But the rates, like I said, the rates are, on the term loans, they range between 7 and 12%. The line, actually, the rates may be a little higher because there are adjustable rates. But yes, so it will be a fee. But again, everything is more cost effective. These lenders, they tend to want to work with the business client. They're not going to put a business client in a position that the fees are so costly that, first of all, they can't repay back the loan because, again, it doesn't make sense for them as well. So it's a situation that everyone will win. Okay?
Yeah. So for the acquisition scenario, is the 6 months for your business or 6 months for that business that you're looking to acquire?
6 months for your business.
Okay.
Right, 6 months. 6 months or more in your business. So, yeah, pretty much. There's always some compensating factors. Let's say, for example, if you, if you're like, if you're a startup, or generally within 6 months, they say 6 months because they want to see trends. They want to see that, okay, this business is doing this over a period of time. So, yeah, but it's 6 months for your business. Yep. Good? Everybody good? Okay.
Yep.
All right. Bridge loans and rehab loans. I love this, right? This is where it's at right now, right? I watched. It's a gentleman that's on YouTube. His name is Grant Cardone, and he talks a lot about multifamily and bridge loans, and I think this is a great solution here. This is good for the investor or owner occupied property, potentially for investment properties. For investment properties. This is good for if anyone's looking to fix and flip, right? So a lot of questions around fix and flip is that how much money do I need? Generally with the fix and flip, they want to see anywhere between I would say between 10 and 20%. Pretty much 20%. Okay, we're going to finance up to 90% of the purchase price, 90% of the rehab costs, 70% of the after repair value. Okay. One of the things with the fix and flip is very important that you do your homework and do your research. Everyone wants to get into the real estate investment game, but it's only really lucrative if you know what you're doing, you know. We have lenders that we partner with that, you know, you can get in those 550. One thing about these rehab and bridge loans, they're a temporary loan, okay? You're in the loan for 1 year. It's a 1 year interest only loan, because you gotta think about a bridge loan is just a loan for you to be able to fix the place up, sell it, or acquire a permanent loan, okay? The great thing about them, there are no prepayment penalties with them, and the interest rate is anywhere between 8 and 11%. But yeah, this is great. This is great for, like I said, that investor that sees some properties that they want to get some cash flow from. I know, you know, I know Rashid, you're an investor as well. You know, if you're looking to get some other properties as well, this could be a great option for you. You know, a lot of traditional banks don't even deal with bridge loans. Like they don't even like this type of solution, because it's too much risk. It's too much risk to the bank. But again, this is great. You know, one of the things, like I said again, one of the things that the lenders find is that the biggest challenge with the bridge loans is that the borrower doesn't come with enough cash to the table. If the borrower is saying it's 90%, you know, LTV, I would always recommend to have at least anywhere between 15 to 20, even though you just need 10, because you never know for the unexpected. Okay, so. Yeah, but any questions around this in general?
Now, what if you wanted to get one of those loans for your primary residence?
Okay.
Could you do that?
No, this is only for investment purposes,
Okay.
investment property purposes, yeah. That's the only thing with the bridge loan and rehab loans, they're just for investment, yeah. So, yeah, what they call it, they're income producing loans. These loans here just to make money. Either you're gonna fix the place up and sell the property and make money, or you're gonna, you know, rent the place out and get cash flow.
All right, so my next question, kind of piggybacking on what she just said, let's say she has a house, she might have bought in foreclosure, let's say 5 years ago. The value has doubled now, but she needs to fix the basement for it to be worth 400, but right now they won't appraise it because it's not fixed. If they know you plan to sell it, and you're gonna sell it at that cost, you just need the funds to do that fix so you can sell it. Does that still apply, or?
Yeah, but see, the problem is right now, her property is considered her primary residence.
Oh, okay.
So it doesn't matter, even if you plan to sell, you fix it to sell it, even if it's your primary residence and you plan to sell it, it doesn't matter if you plan to sell it or not, it just has to be, it can't be a primary, it has to be investment.
Right, and then she can get what they call a 203K loan on
Yeah.
the residential side. That's a 203K. So she could do that. But if these loans, you don't live in these loans. Like you don't live in a property actually. So yeah, so if this was just strictly like, if for example, if we were, you know, gonna buy a single family home as an investment purpose, we never lived in it at any point in time, we're renting it out, this would be where we could use this to do that. Yeah, so it is I mean, of course there's loopholes there, you know, but primarily these loans are for investment purposes only.
Okay, so the 3 months reserve payments, you're gonna make that when you get the loan, you have to pretty much put down, it's kind of a down payment.
Yeah, the 3 months, that's a good question. The 3 months interest reserve is that the lender wants to see, not only because remember, they're gonna finance up to 90% of the purchase. So let's use some raw numbers. Let's just say, for example, if the 100,000, right? You know, basically you gotta come up with 10 grand, okay? So they're gonna finance up to 90, okay? But then it takes another 50,000 to rehab it, okay? So at that point now you're coming up with another what, 10 grand, you know? So at that particular point you're coming up with 20 grand now. And so they want to see at least the minimum of at least 3 months interest reserve still payment somewhere in your account, because they want to see that, you know, for the rehab cost, the purchase price, and you still have money to make the loan payments. So that's why I always say it's good to have anywhere between, you know, 20 to 25%, because you never know. But really the 20% should be enough. But they want to kind of just see that you have cushion, because a lot of times the worst case scenario is that with these rehab projects, that, you know, especially most investors, especially novice investors, they're not contractors or construction contractors. So they don't really know, you know, they get like an estimate, and then next thing you know, the project costs much more than what you anticipated. So now you're spending more money, and you didn't realize that it costed that much because you're not a licensed contractor, right? You thought that you was just coming in to, you know, do some drywall stuff, but now you realize it's structural damage. That's another 40 grand. So now you got to figure out what you're going to do, because now you're already in the loan. So they want to see that you can still have that payment here. The interest reserves is basically like seasoned funds that before they go to closing, that you still have that money allocated to make payments on the loan. That's what that is. Yeah, yeah, so, but again, the rule of thumb is really to always have anywhere between 20 and 25%, okay? If the loan is 100,000, okay? If the loan is 100,000, you wanna have at least 25% of that, you know? So, you know, you wanna have at least 25 grand, okay? To be on the safe side, you may only use 20, but again, there's always the unexpected. Did I answer your question?
Yes.
Okay. Yeah.
And they want cash. They don't want you to be creative and leverage, say, if you have any of these other lines, credit, pool.
I mean, essentially, they're gonna finance 90 for you. So they just want, again, it's just skin in the game. To these lenders, they just wanna make sure, we're gonna finance up to 90% of the loan for you. What are you putting in? Like, you know, they just wanna see that you're committed too. So, but you're right, you could use, the great thing about these two, these loans here, this is not really like a debt service coverage ratio when we look on the commercial side, on the SBA side, because a lot of times they're looking at, you know, your expenses and your revenue. But with these loans here, I mean, if you can come up with the capital, right, that's a good question. I mean, you can deplete other sources, yes. But remember, you still gotta be able to pay that back as well. But exactly, you can certainly do that for this loan, yeah. Because this is a bridge loan, and so, as long as you have essentially the 20%, you know, it's a conversation. You can put a contract on a property and you can move forward. Yeah, but this is, like I said, I mentioned a gentleman before, Cardone, but I would recommend, you know, this is something I'm doing myself, you know, really start researching in multi-unit family homes, right? A lot of everybody invests in single family, is no knock towards that. But when you talk about passive streams of income, I mean, when you have like he's talking about 4 or 5, he's talking about 4 units and up, right? Because I was looking at, even in our area, in the surrounding areas, outside of the Baltimore area, there's like a 6-unit for like $300K. 6 units, like 6-unit apartments. I mean, you rent those out for $1,000. I mean, the cash flow on that could be amazing, you know? And then again, you're not concerned like if one tenant leaves, if you rent out your single family, I know, you know, somebody's in there for a short period of time or a good amount of time, but if that person leaves, then you're worried about the vacancy again, then you have multiple streams of cash flow. So the multifamily is something to look into and do some research, and that's certainly what I would recommend around that. I think when it comes to historical data based on what are you getting your most returns on from an investment property, the multifamily units and commercial properties. I mean, single families are great, and again, I'm not trying to say they're not great, but if you're trying to build generational wealth, and you're trying to have, like I said, generational wealth and really be in a certain, bracket in terms of how much money you're trying to make, it's probably, you gotta take advantage of the commercial market. That's what you wanna do. You wanna take advantage of commercial, multi-family units. Yep. Any questions around this?
I'm good. You're clear.
That's good. Perfect. All right, now we're talking about CRE loans. So this is a great option. How you doing there, sir? Thanks for coming out. Yep, so CRE loans is, this is basically called commercial real estate loans. This is a great option. This is essentially, a commercial real estate loan is like, say, something like this. Right now, we're currently in a strip mall, retail mall. There's a lot of different commercial retailers. These loans are, for essentially strictly investors. Boom. This is for investment in commercial space, primarily. Again, this could be hotels, apartment complexes, strip malls, anything that's gonna, have commercial use. The game in the commercial space, you gotta have at least 20-30% down. It's no question. There's no question about that when it comes to the commercial space. The great thing about these loans